monetary policy tools, or you can call it monetary policy instruments. We have various instruments that can be adopted by the Monetary Policy Authority or the apex bank in the banking sector, which is the CBN, to control the economy. Now, when you talk about the monetary policy, we are simply talking about the actions being taken by the monetary authority to control the supply of money, at the same time the credit condition, primarily to ensure price stability and to stimulate economic growth. Now, let's look at some of the instruments or tools that are being used by the monetary authority to control the economy. We are starting with what we call MPR, monetary policy rates. By monetary policy rates is simply the benchmark for setting all other interest rates in Nigeria. And during the monetary policy committee meeting, which was held between 19 and 20 of May, the monetary policy committee member unanimously agree that they should retain the MPR at the rate of 27.50%, which means any other interest rate in Nigeria is rotating around 27.50%. So if the commercial bank want to give loan to their customers, then that loan, the interest will be within this range. And now looking at this interest rate, 27.50 is on the high side. So the cost of borrowing is very high. And when the cost of borrowing is very high, it means the cost of production of any company or firm that borrow loan from the commercial bank will also be high. And the increment may later be passed on to the final consumer, especially if such a company enjoy what is called inelastic demand. Now, why do you think the government decide to put the monetary policy committee? Why do you think they decide to put the MPR or retaining around 27.50%? Because they believe that the inflation in Nigeria is still high. I think when the Federal Bureau of Statistics released the inflation figure for the month of November, for the month of April, we have 23.71%, while that of March was 24.23%. So since the inflation figure in Nigeria is still a double digit, so they decide to retain the MPR. That's one. Now let's look at cash reserve ratio. I want to explain cash reserve ratio mathematically. Now, during the Monetary Policy Committee meeting, the meeting was 300 that was held in the history of Nigeria Policy Committee meeting. Now, it was agreed that the commercial bank in Nigeria cash reserve ratio should be 50%, while for the merchant bank, the cash reserve ratio should be 60%. Now, see what they are saying by cash reserve ratio. If a customer, we want to assume that a customer deposits 1,000 naira, the bank is expected to keep part of the customer deposits as cash reserve ratio. So we are going to say 1,000 multiplied by 50 for the commercial bank over 100. So we are going to have 10 times 50 is going to be 500, which means on every deposit made by the customer of the commercial bank, they are expected to keep 500 naira in their vault or with the CBN, while the remaining 500 naira can be given out as a loan to their customer. That is cash reserve ratio. And this is done in order to control the supply of money in circulation. Or if the government wants to control inflation, what they will do, they can even increase our cash reserve ratio. By increasing the cash reserve ratio, it means they are going to mop up more money in the circulation. But when they reduce the cash reserve ratio, it means they want to pump more money into circulation. Now, I will explain what is called cash reserve ratio. What then do we call asymmetric corridor? This is another instrument used by the Monetary Policy Committee, Monetary Policy Authority, to equally control the economy. Now, the asymmetric corridor is between 5 plus 500 over minus 100. It's just a range. It's a range around the MPR. The asymmetric corridor is the range around the MPR, which states the rate at which they want to borrow and the rate at which they want to lend money to the commercial bank. For example, now, if the commercial bank want to borrow loan from the Central Bank of Nigeria, the asymmetric corridor is going to be the upper. We have what is called upper band. And the upper band is plus 500. This is the rate at which they will borrow. Now, the lower band, it is the rate at which they will lend to the central bank. Now, what do I mean? The upper band here, if the commercial bank wishes to borrow loan from the central bank to meet up their liquidity, in that case, the asymmetric corridor is going to be set above the MPR. Asymmetric corridor will be set above the MPR because the commercial bank is borrowing money from the central bank. Now, if the commercial bank want to lend their excess liquidity to the central bank, then the MPR will be the asymmetric corridor. That MPR will be set below the asymmetric corridor. Now, this one is going to be above asymmetric corridor. That is the upper band. Upper band. That is the rate at which they are borrowing loan to the commercial bank. It's going to be above the MPR, which is 27.50%. Why the lower band means that the commercial bank here, they are lending their excess liquidity to the commercial bank. And if that is being done, it means the MPR, they are going to set asymmetric corridor below the MPR. Why this above for borrowing, when they are lending, is also below the MPR. That's in the case of asymmetric corridor, which is plus 500 over minus 100. So this is the rate at which the commercial bank will borrow, and this is the rate at which the commercial bank will lend the money back to the CBN. Now, in terms of liquidity ratio, I want to use a treasury bill to maintain, to explain what we call a liquidity ratio. The treasury bill is a short-term debt instrument that can be used by the monetary authority to mop up the excess liquidity in circulation. Now, if the central bank want to inject money into circulation, what they need to do is to reduce the rate on the TB. But if they want to withdraw the money from circulation, all they need to do is to increase the rate on the treasury bill. Now, let's look at what happened to the treasury bill this week. Treasury bill was auctioned, I think, on Thursday. Now, the treasury bill that was auctioned, we have a 364 days treasury bill. We have a 91 days treasury bill. We have 182 days treasury bill. Now, the 364 days treasury bill, the interest rate, which is the stop rate, is 19.56%, while the one of 91 days is 18%. Then the one of 182 days is 20%. Now, I know somebody may be asking, how come the rate on the 364 days, which is almost a year, is 19.56%, while that of 182 days is 20%. Now, the stop rate, we are not actually concerned about the stop rate, but we have what is called a true yield. True yield. Now, the investor, a good investor, will look at what is called true yield, not even the interest rates. Now, the true yield on the 364 days, the true yield is 24.33%. 24.23%, while for the 91 days, the true yield is 18.86%, while on the 182 days, the true yield is 20.40%. Now, you can see now that even though the interest rate on the 364 days is 19.56%, when you look at the true yield is 24.23% for 364 days, while the 91 days of treasury bill is 18.86%, while the one on 182 days is 20.40%. Now, we saw a strong appetite for these fixed income instruments, which is the treasury bill. In fact, the 364 days was oversubscribed by the investors. And why was it oversubscribed? Investors have noticed that for the CBN to retain the MPR, it means we may likely be returning to what we call dovish interest rate. We have dovish interest rate, we have hawkish interest rate. Now, in terms of hawkish interest rate, what I mean by say hawkish interest rate is the tightening of the monetary policy, which we have been experiencing throughout last year. We were experiencing what is called tightening monetary policy, meaning that the CBN have been hiking the monetary policy rates. It was increased 6 times last year, and that's an added advantage to the fixed income instrument. Now, they've been maintaining hawkish, but for them to have retained these 27.50%, which second time this year, February it was retained, and May it was retained, which means we may likely be returning to what is called a dovish interest rate. By dovish interest rate, it means a lower interest rate. And by lower interest rates now, the fixed income market or fixed income instrument may no longer be attractive, because when we have what is called a dovish interest rate, it means the MPR may likely be reduced. And when there's a reduction in the MPR, this TB that you are seeing here, this interest rate will equally come down. But the investor decide to subscribe for 364 days. They lock in their capital for 364 days because they are suspecting that as time goes by, it could be during the next monetary policy meeting, they may decide to reduce the MPR. And by reducing the MPR, it means the interest rate on the commercial paper, even NJ savings bond and the treasury bill may likely be coming down. So now we have what we call the equity markets, and you have what is called fixed income markets. The fixed income market belong to fixed income instrument like treasury bill, like commercial paper, like NJ savings bond. While the equity market is of the one of shares. When you are trading shares, when you are trading your ETF, that's equity market. So when there is a reduction in the MPR, then the fixed income market will no longer be attractive to the investor. So investors tend to shift their attention from the fixed income market back to the equity market. So I think we still have some of the other instruments that can be used by the monetary policy to equally control the economy. We have something like a moral. We have a moral suasion. In terms of moral suasion, this is just a gently appeal made by the monetary authority to the commercial bank as to which sector of the economy they should direct their lending policy to. What I mean is this: here they can just appeal to the central bank can appeal to the commercial bank that they should compensate their lending policy to one particular sector of the economy. It could be maybe health sector or food and beverage sector. They can just advise. So this one is not by force. You are trying to persuade them. It's a genuine appeal on the part of the monetary authority to advise the CB, to advise the commercial bank as to which sector of the economy they should direct their lending policy to. Apart from that, we have another one we call it special directives. A special directive here, which is another instrument of the monetary policy tools. Here now, this instrument of special directive. It is not an appeal, but rather it's a directive. It's a standing order given by the CBN to commercial bank as to which sector of the economy they should direct their lending policy to. Here, it is an attempt on part of the monetary authority to mandate the commercial bank to direct their lending policy to one particular sector of the economy. Now, we have been able to explain what is called the MPR, the cash reserve ratio, the asymmetric corridor, the liquidity ratio, the moral suasion, the special deposit. These are some of the instruments that can be used by the Central Bank of Nigeria to control the economy. With this, we've come to the end of today's class. Until we meet again, do have a nice day. Thank you.